Welcome to the deep dive. We're here to, cut through the noise and really focus on insights that matter.
Okay, so let's unpack this one. Imagine we could take a little trip back to 1995.
Okay.
Not in some fancy sports car, but with, well, a stack of documents, really insightful ones. A shareholder letter from the Markel Group.
Ah, Markel.
Yeah.
A big name now.
Exactly, a titan today. But what can we actually learn from looking at them way back then, almost 3 decades ago? What was going on at that pivotal moment? So our mission really is to pull out the most important nuggets from this old letter. What does it tell us about, business strategy, investment thinking, principles that last? What were the key things defining Markel in 95? And maybe more importantly, what can those lessons teach you today? Yeah, and what's so fascinating, I think, is we're not just looking at numbers on a page. We're actually getting a glimpse into the mindset, right? Thinking of a company at a really critical point. They're navigating this industry that's totally in flux. And they're consciously laying the groundwork for what came later. It's about understanding the why behind the what, the strategy driving it all.
Exactly. And that's what we want to do for you listening, give you that shortcut. A clear view of Markel's early insights, some memorable details, and hopefully a fresh perspective on building something for the long haul. So let's dive in. Let's set the scene for 1995. Okay, here's where it gets really interesting. To get why Markel's 95 was impressive, we need the context. What was the business world like then?
Yeah.
Especially, for insurance.
Right. Well, the property and casualty insurance industry, in a way, was tough, to put it mildly. The letter itself calls it intensely competitive. And you had a lot of companies sort of stuck in this commodity cycle.
Meaning just competing on price. Everyone looks the same.
Yeah. Pretty much, yeah. When products are hard to tell apart, the only lever seems to be lowest price, which, often leads to price wars, shrinking margins. It's a race to the bottom, really, and this whole environment, it led to pretty poor results across the industry. Lots of insurers were dealing with substandard shareholder returns, as the letter puts it. Part of that was strategy, part was these big environmental liabilities hanging over from past mistakes.
Those sound ominous, like unforeseen costs.
Exactly. Hard to quantify, hard to get rid of, put huge pressure on their finances. So it really raises the question, right? How does a company even survive, let alone thrive, when the whole industry is struggling like that? How do you break out of that commodity trap?
Right. It sounds like a brutal environment. And it wasn't just competition, was it? The industry itself was shifting. The letter talks about this big wave of reorganization, consolidation.
Oh, absolutely. Massive changes.
Yeah, they give specific examples. Home insurance company, acquired by Zurich. Continental sold to CNA. Aetna did a deal with Travelers. Taligent, that used to be Crum and Forster, got bought by KKR. These are big players.
Huge names.
And even CIGNA was splitting itself up, selling off pieces to Home, Continental, Aetna, Taligent. The letter says these deals altogether represented something like $14 billion in business.
$14 billion.
Which was 6% of the entire industry's premiums at the time.
Wow.
Talk about a landscape in constant motion, just total upheaval.
Yeah, it's almost Darwinian, like you said. When the big fish are thrashing around, merging, restructuring, it creates massive risks, but also maybe unique opportunities for others.
So how did Markel respond? What was their move in all this chaos?
Well, their strategy was pretty clear, and they stuck to it. They focused on specialty products in unique market niches. They weren't trying to go head-to-head with the giants on price in those big commoditized areas.
Aren't. Go where the others aren't, or where you have an edge.
Exactly. Serve specific, maybe overlooked segments where their expertise actually mattered and could command a better price. And they were pretty honest about it, too. They acknowledged that words like specialty and unique were often misused and certainly overused in their industry.
Okay. So they knew it sounded like jargon, but they meant it.
Right. It suggests they weren't just, slapping a label on things. They genuinely believed their approach was different, more focused. And if you connect that to the bigger picture, it's not just about, market segments. It's a core belief in creating a real competitive advantage through expertise. Think of it like being the best bespoke tailor instead of a mass market clothing factory.
That's a great analogy. It's about value, not just volume.
Precisely. And that's a huge lesson for any business facing tough competition. Find your unique value.
Okay, so that was the strategy. Specialize, differentiate, avoid the commodity scrum.
Yeah.
How did that actually translate into performance? Did the niche strategy work in 1995? So, given that really tough environment and their specific focus, what did the bottom line look like? Let's get into the financial highlights for 95.
Right. Well, despite all those industry headwinds we talked about, 1995 was actually a record year for Markel. Their net income hit $34.5 million. That's 6.1 high dollars per share. A record for them then.
Wow, okay. Record income in that market.
Yeah. And maybe even more impressive, shareholders' equity per share jumped to $39.37, which was an increase of 53%.
53%.
In 1 year. 53%. So yeah, not just good numbers, outstanding numbers, especially considering the context. And the letter is careful to point out this wasn't just, a lucky break. They framed it as the result of long-term achievements. They said they built a foundation that has yielded outstanding results.
So it's about discipline paying off.
Exactly. Disciplined underwriting, meaning they were careful about the risks they took and priced them right, not just chasing market share. Combine that with really strong investment returns, and you get a genuinely successful year. They weren't just making money, they were building lasting value.
Okay, and what about the core insurance business itself, the premiums?
Yeah.
The letter mentions earned premiums averaged 34%, and their premium volume grew quite a bit, didn't it?
It did. They went from $152 million in 1991 to $285 million in 1995.
So nearly doubled in 4 years. That's strong growth.
Very strong, especially, again, in that tough, consolidating industry.
It really shows that niche strategy wasn't just about playing defense. It was allowing them to actually grow meaningfully in their chosen spots.
Right. But what I also find really insightful is their outlook, even after such a great year. They were quite pragmatic, quite realistic.
They weren't getting carried away.
Not at all. The letter says, profitable growth in the current competitive environment may be difficult.
Yeah.
But then crucially, but not impossible.
Okay, acknowledging the challenge, but still optimistic.
Yes. They weren't making wild promises. They expected modest growth from most of our existing products because the competition was still fierce. But they plan to supplement that with stronger growth from our newer lines. So still innovating, still expanding within their specialty areas.
And looking for deals too, right?
Right. Actively looking for chances to develop or acquire new products. So a proactive stance on finding new niches. It's this balanced view ambition combined with market realism that really speaks to prudent management.
Yeah, that's a key point. They weren't just chasing any growth. They were after profitable growth. Big difference.
Huge difference.
Okay, so the insurance side was doing well through discipline and focus. But you mentioned investment returns. That was a big piece too, wasn't it? Almost like a second engine driving things forward.
Oh, absolutely. You can't really understand Markel, especially back then, without looking at the investment side. It was deeply intertwined. Their corporate philosophy was very clear. You need both strong underwriting profits and superior investment returns to build shareholder value.
The dual engine.
Exactly. That's the core concept. And it's something maybe not everyone fully grasps about their model. They pointed to their strong loss reserve position and solid underwriting track record as the foundation.
Because that gave them stability.
Stability and flexibility. Good underwriting means predictable cash flows, strong reserves. So unlike other insurers who might have to keep investments super conservative just to cover potential claims,
Right.
Markel had the financial strength and flexibility, as they put it, to manage our investment activity for higher returns.
Ah, so good insurance operations enabled better investing.
Precisely. They could afford to be more patient, more opportunistic with their investment portfolio because the insurance side was solid. That balance, that synergy was really evident in 95, a powerful competitive advantage.
And the results, you mentioned they were good. How good?
Well, the portfolio itself grew 49% just in 1995, reached $909 million.
49% growth in the portfolio.
Yeah, and the returns were, frankly, spectacular for the time. Equities returned 29.7%.
Wow.
Fixed income, 14.4%. The combined portfolio return was 15.7%.
Those are fantastic numbers.
On top of that, they had a net unrealized gain of $34 million at the end of the year, even after accounting for taxes.
Imagine seeing that on your statement.
Yeah.
So what was the secret sauce there? How did they achieve that kind of growth and return? Was it just luck?
No, definitely not just luck. It was very deliberate. The letter actually breaks down some of the sources. There were some one-time transactions that helped boost the portfolio size, like $83 million came from commutations with reinsurers.
Okay, what does that mean exactly, commutations?
It's basically when an insurer and its reinsurer agree to end their contract early. The insurer usually pays a lump sum to take back responsibility for future claims. It can free up capital, simplify things, gives you more cash to potentially invest.
Got it. strategic move. What else?
There was $60 million related to acquiring Lincoln Insurance Company that likely involved moving assets around or injecting capital. And interestingly, $19 million came from selling their home office buildings and then leasing them back.
Ah, the old sale leaseback.
Right.
Frees up capital tied up in bricks and mortar.
Exactly. Turns an illiquid asset into cash they could put to work elsewhere, presumably aiming for higher returns than owning the building provided.
Smart. So those were boosts to the capital base. What about the ongoing investment income?
That was strong, too. Dividends and interest brought in $45 million, up significantly from $29 million the year before.
Or
Part of that was just the portfolio being bigger, obviously, but they also note the annualized yield improved. So quality investments were paying off. And they weren't just clipping coupons. They realized $12 million in capital gains.
selling assets for a profit.
Right, up from $4 million in '94. And about 40% of those gains actually came from their fixed income portfolio. They were actively managing that, too, reducing municipal bond exposure, for instance.
So it wasn't passive investing at all.
Not at all. It shows a very deliberate strategy. Manage assets for long-term total return. They were actively looking for equity appreciation, timing their gains, optimizing the bond side. It's dynamic capital management, fueled by that strong insurance engine.
That paints a really clear picture of how the two sides work together. Insurance discipline feeding investment opportunity. Okay, so we've got the strategy, the numbers, the dual engine. But behind every great company, there are people. What did the letter say about Markel's culture and its associates back in '95?
Yeah, this is crucial, I think. They were very explicit about attributing success to their people. The letter states pretty directly, the primary reason for these results has been the commitment to success made by our associates.
They didn't just say employees, associates.
Right, and they called them the chief architects of our success. So that's strong language.
It really is, more than just corporate speak.
I think so, because they tied it to this idea of alignment. They said, customers' interests, our associates' interests, and our shareholders' interests are all aligned.
Ah, getting everyone pulling in the same direction.
Exactly. And that's not just, a nice sentiment. It's a core belief that if your workforce is motivated and literally invested in the company's success, that's critical for long-term performance.
Yeah.
Creates a powerful synergy that's actually pretty hard to replicate.
So how did they make that happen? Did they just say it, or did they structure things to create that alignment? It sounds like they really put their money where their mouth was, offering exceptional bonus and stock ownership opportunities.
They absolutely did. The details are quite telling.
Yeah, like associates could put their 401k contributions into company stock.
Right, all or part of it. A very direct way to become an owner. And the 401k plan itself held over 113,000 shares back then. That's a significant collective stake.
And there were other ways too. Payroll deduction.
Yep, made it easy to buy stock gradually. And they had this program, over 200 associates participated, where they could buy stock using low-interest loans from the company.
Wow, actively helping them buy in.
Yeah, and through that program alone, they owned over 125,000 shares.
That's a serious commitment to spreading ownership far beyond just the top executives.
It really is.
How do you think that kind of broad ownership might have actually affected how people worked day to day, their mindset?
Oh, it changes everything, doesn't it? When you're not just an employee, but an owner, even a small one, your perspective shifts. You're not just working for a wage. You're working to increase the value of your asset.
Right, you care more.
You care more. You think longer term. You're probably less likely to leave because you're building equity. It fosters that owner's mindset throughout the company. People look for ways to save money, find opportunities, solve problems, because it benefits them directly.
Creates an entrepreneurial spirit almost.
Exactly. And in a tough industry where good talent could easily go elsewhere, that's a powerful way to keep people motivated and aligned. A huge cultural driver. And speaking of culture and people, the letter also took a moment for a saying goodbye section.
Oh, who was that for?
Milton Markel, one of the founders of the team who had passed away. They described him as a businessman whose common sense and integrity served as an inspiration for a generation of Markel leaders.
That's a lovely tribute.
It is. And it's more than just remembering someone. It highlights how leadership and core values get passed down. It's about acknowledging the foundations, the integrity that shaped the company, and making sure those principles carry forward. Connects the past to the future.
That's a great point. It grounds the current success in those founding values.
Mm-hmm.
Okay, so let's zoom out. We've looked at the tough market, the niche strategy, the dual engine, the people-centric culture. Looking back now, almost 30 years later, What are the big, timeless lessons here? What can you, listening today, really take away from Markel's 1995 playbook?
Well, several things jump out, I think, and they feel just as relevant now as they did then, maybe even more so. First, definitely the power of finding and dominating specialty niches. In a world where so much feels commoditized, Markel showed that deep expertise in specific areas allows you to escape the price wars and build real value.
Don't try to be everything to everyone.
Exactly. Applies to products, services, even your own career path. Find your unique edge. Second, that dual engine concept. The synergy between disciplined operations generating cash and smart, patient investing compounding that cash.
Right, underwriting plus investing.
It creates this incredibly robust, self-funding growth machine, gives you resilience and options. Third, you absolutely cannot overstate the role of people and culture. Aligning everyone's interests through ownership, through incentives. Markel understood your workforce is your primary asset. Treat them like partners.
Invested partners, literally.
Yeah, literally. It drives performance, loyalty, everything. And maybe fourth, just the importance of clear, honest communication with your shareholders, your equity partners, as they called them, building that trust. So, it makes you wonder, in today's world, with all the rapid change and focus on disruption, do these fundamentals, niche focus, disciplined operations, smart capital allocation, strong culture, actually become more critical for long-term success, not less?
It's a really interesting question. Maybe they're the bedrock that allows you to navigate the changes. Yeah, these aren't just quaint stories from the past. They feel like core principles. So for you listening, whether you're building a company, managing money, leading people, or just curious about how enduring businesses operate, this 1995 snapshot of Markel, it really offers a fantastic blueprint. Disciplined growth, strategic focus, long-term thinking. It clearly worked.
It absolutely did.
It's a great reminder that sometimes the fundamental truths just endure, even as the world changes around them.
Right. And maybe a final thought to leave folks with. Considering Markel's incredible journey since 1995, they've grown immensely, diversified way beyond specialty insurance. What could the leaders in your company, or maybe even you in your own personal strategy, gain by really digging deep into the core principles guiding long-term success? Instead of just chasing the latest trends or the next quarter's numbers, what are the fundamental truths you're building on?
That's a powerful question to reflect on. What are those enduring principles for you? Thank you for joining us on this deep dive into Markel's 1995. We hope exploring these timeless ideas has been valuable, and maybe it encourages you to keep looking for those fundamental principles in your own work and investments.